Hey, it's the 1st of December. I think I owe you guys a video. I've been talking about how stock markets are likely to top out. I gave a big speech in my video over the weekend, and I followed it up with a video yesterday before the Fed Chairman Powell's speech. Now, I was wrong about that. Stock markets, which had turned around and gone lower as I had expected around here, for example, in the S&P, absolutely rocketed yesterday. I mean, I don't understand this, if I'm honest. We went up 150 points from yesterday's low in the S&P. What's that? Is that 4%? Near enough. 4%. You would have thought they had cut rates, just as you would have done here on the 10th of November, which I'm guessing was the CPI day, when the CPI collapsed by a massive 0.2%. I mean, you can only miss the target by 0.1%, and it missed it by 0.2%, and yet we had we went up about 5%. So clearly the bulls are winning at the moment. The levels are clear as well. You know, a nice level around 39.25, 39.20, which we didn't quite get to yesterday, but that was my buy level. Anyway, where am I? I've got a lot to try to explain because people are asking me what's going on, why are we going up, what's going on with the economy. I'm going to try and explain it all now. Okay, well, we got through the 200-day moving average, which was working as resistance for the S&P, and we've now run into a lot of trendline resistance. So this trend line goes all the way back to January of this year, so it is an 11-month trend line. We have another little trend line just joining the peak here in March to the peak here in August, which comes in fractionally lower. So this whole area is 4090, 4100. And clearly we've also got the upper trend line of this, what could be a rising wedge, which is in fact a negative pattern, but obviously it's not negative at the moment until we break down below 39.20. So we've got three big trend lines which are definitely creating resistance today because we've turned around from 40.96. Is that the peak of the bear market recovery? I think it could be, although you're probably not going to believe me because I told you that 40, 50, 40, 70 probably would be, and of course we've pushed higher. Now, we've got negative divergence on the daily stochastic. You can see that this has not managed to meet the two previous peaks from the double top. So there is a bit of negativity there. We are overbought, I think, on the weekly chart, just getting overbought. And also on the weekly chart, I've got a really nice trend line going back to the beginning of 2015. Joins the peak in 2018, joins the peak in 2020. That was just as the COVID crisis hit the global economy. And boom, there we go. Now that trend line comes in at, I want to try and be accurate, 4110, 4115. So we really are approaching a lot of trendline resistance. What else can I say? Overbought on the 4-hour chart, but that's no big deal. But we've got no negative candles yet. So it'd be interesting to see what happens today. Do we back away from those 1, 2, 3, 4 trend lines, one of which is actually 7 years old? So it is a pretty big deal. Okay, looking at the CNBC website, what did Powell say? Well, he confirmed that smaller interest rate rises are likely ahead, even as he sees the progress in the fight against inflation as largely inadequate. So he's basically saying that we need to put interest rates up significantly more, but we're not going to put them up by 0.75%. We're going to put them up by 0.5%. Okay, after however many times they've already raised rates by 0.75%. The 0.75% is an enormous rate rise. We're used to seeing them before this year, rate rises of 0.25%, and we've seen a number of 0.75% rate rises. So, and that hasn't even normalized rates yet. They have to go significantly higher, according to Chairman Powell. So we've probably got, what is it, 3, I think, are expected, 0.5% rate rises. So just because they're going to come over 3 months instead of 2 months, I don't see that as enormously bullish. But anyway, other people clearly do. Now, Federal Reserve Chairman Powell noted caution that monetary policy is likely to stay restrictive for some time until real signs of progress emerge on inflation. In other words, we're going to put rates up and we're going to leave them there to do their work on slowing down the economy. Despite some promising developments, we have a long way to go in restoring price stability. He noted that policy moves such as interest rate increases and the reduction of the Fed's bond holdings generally take time to make their way through the system. Well, that certainly seems to be the case. We'll have a look at that in a minute. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint. They're not at the level of restraint that will be sufficient to bring inflation down. So we've still got a way to go. The time for moderating the pace of rate increases may come as soon as the December meeting. Okay, so we're only going to get a 0.5%. Well, that's actually still a pretty big move in interest rates. Looking at the inflation rate, you know, we've been up to close to 10%. What did we get to? 8 point something, if I remember correctly. Now, on the grand scale of things, when you go back decades, it's not a particularly abnormal inflation rate compared to other spikes. Not at all. But of course, it's coming from a ridiculously low base. Now, even if inflation does come down again, do you really see it much below 5%, 4%? Looking at history, and then when we look at the Fed funds rate, this is, people think, you know, especially if you were born maybe in the 80s or the 90s, you might think that 0 interest rates or 1% interest rate, 2% interest rate is normal. And that's what happens. It is not normal. When I started buying property back in the 90s, I got a 7.5% interest rate on my mortgage, and I was dancing in the streets. That was an incredibly low rate compared to what had been experienced before. Now, property prices, certainly the house that I bought back then was £250,000 for a 4-bedroom house on the outskirts of London, probably worth 1.5 million or more right now, as the interest rate approaches where it was when I was buying that property. So the property is probably 6 or 7 times more expensive, but the interest rate is soon going to be roughly the same. So financing costs are absolutely enormous. Have wages risen by 6, 7, 8 times in those 2 decades? I don't think so. Now, more to the point, interest rates are not going, are not pushing up for a temporary high around 5%, and then they're going to return to 0. That's not normal. This is abnormal, 0%. We're not going to see that again. Rates are not going to 1%, 2%, 0%. That's never going to happen again. I can't see any reason why it would anyway. We already know that that was probably a big policy mistake, which has led to this inflation. So we're just normalizing rates. Rates should probably be around 5% in a reasonably healthy economy. But the problem for this economy is that asset prices have absolutely gone through the roof because of this 1.5 decade period of ridiculously low interest rates that created all the bubbles that we know about. Okay, so how likely is inflation to collapse in the months ahead? Well, how strong is the economy? Here's the unemployment rate. Unemployment doesn't exactly look like it's going up, does it? I guess this spike up here is when everyone was furloughed over COVID and nobody was working. But the unemployment rate is historically low. I mean, it's lower than at any time through the first 15 years or first 15 years of this decade, anywhere through the 70s, 80s, 90s. You know, we have to go back to, what's that, the early 70s before we see an unemployment rate so low. So everyone who wants a job has got a job. Not surprising, therefore, if there's probably a shortage of workers, that we've got US wages and salary growth looking very, very strong indeed. Very strong. So now way higher than it's been for the last, well, since the turn of the century. And I don't see how that is going to suddenly turn around and go down below 5%, down to, 4, 3, 2%. I would have thought that that sort of wage growth is here to stay. And it's not abnormally high anyway, even where we are right now. And it's come down a bit. We're only getting towards where the peaks have been, as you can see, since the turn of this century. Not particularly high when you go back into the 90s. It's about, we're coming back towards where it was about average, and in the 80s as well. So it's a relatively healthy number. But when you've got salary growth like that and almost full employment, or certainly very low employment, that to me sounds inflationary. Now, if people are earning more money and everyone who wants a job has got a job, are they spending it, the money, or are they saving it? Well, here's retail sales up to October 2022, up to last month. I think you can see that retail sales are on a good, steady climb, according to this chart over the last 3 years. Let's have a look at the 5-year chart. Pretty steady climb. 10-year chart. Oops, don't want to start a free trial. 10-year trial. Oh no, okay, I can't do that. Anyway, look, you can see retail sales have been on a steady climb. People are spending the money, that they're earning increasing amounts of money, and they are sure as heck spending it. Does that sound deflationary to you? Now that even as savings rates in the US go to sort of 3% or even 3.5%, is that encouraging people to save? No, it looks like they're spending, and from what I'm hearing, the high street is still pretty busy. People are out eating and enjoying themselves and spending money. Savings rates, interest rates for savers has climbed nicely, of course, with the Fed funds rate going up towards 5%, well overtaking the dividend yield for the S&P. So what would you rather do? Get 1.8% yield on the S&P when we could be heading into a very large recession, or would you rather stick it in the bank and get 3.5% guaranteed on your money no matter what happens to the economy? Okay, I'm no expert economist and I'm just looking at basic numbers here, but it looks to me like there's no problem with unemployment. There's no problem with people earning a lot of money. They don't seem to be saving any of it, despite the fact that their mortgages have gone up and their energy costs have gone up. And so, yeah, maybe the stock market is reflecting strength in the economy, but ultimately it's only going to lead to interest rates which will continue to go up, which will continue to bite. And one day, eventually, people have to stop spending money. People have to stop putting money on their credit cards. And surely, the longer this goes on, the deeper the recession will eventually be, because the higher interest rates have to go. We've got US unemployment out tomorrow, non-farm payroll. I'm guessing if it is a strong number, as in jobs are still being created at a strong pace, I can't really see that being bullish for the economy, because it does mean that the Fed are going to be forced to put rates up higher for longer until these interest rate rises actually start taking effect and stop people spending money. Anyway, there you go. We'll see what happens. If we close the week on the S&P above 4110, that would be a buy signal for the next week. But just be aware, we are still hitting very strong resistance levels in the S&P.